Most investors buy stock based on tips, news, or gut feeling. But the real wealth in the stock market is built by those who know how to analyze business fundamentally. So friends, in today's video, we will learn the fundamental analysis of stock. So stay tuned to my channel Finance Eco India. Let's begin. In today's masterclass, I am going to take you through a step-by-step guide on fundamental analysis of stocks. By the end of this video, you will be able to look at a company, study its number, and decide whether it's worth your hard-earned money. We will cover what fundamental analysis is, how to read balance sheet, income statement, cash flows, the most important ratios investors use, qualitative aspects like management mode, industry analysis, real-life case studies of Indian and global companies, a step-by-step checklist for analyzing any stock. So grab a notebook because this video is going to be your crash course in the investing like a pro. First, what is fundamental analysis? It's the process of evaluating a company's true intrinsic value by looking at both its number and its business model. There are two schools of thought in stock analysis: technical analysis, short-term price trend and chart; fundamental analysis, long-term business strength and value. If you want to invest for the long term, like Warren Buffett, Rakesh Jhunjhunwala or Peter Lynch, you must master fundamentals. Two key goals of fundamental analysis: to determine whether a stock is undervalued or overvalued, to decide if it's worth holding for long-term wealth creation. Think of it this way: buying a stock without analysis is like buying a car without checking the engine. Fundamental analysis opens the bonnet and shows you what's inside. Now that you know why fundamental analysis matters, let's get into the foundation of stock analysis: financial statements. Think of the section as learning how to read the language of business. Every listed company is required to publish 3 key financial statements, and together these statements tell us the story of company's health, growth and future potential. The 3 statements are balance sheet, income statement, also called profit and loss account, cash flow statement. Let's break each of them down in simple terms. The balance sheet. A balance sheet is basically a snapshot of a company's financial position at a given point in time. It tells you what the company owns and what it owes and what is left for shareholders. The golden rule is assets is equal to liabilities plus shareholders' equity. Assets are what the company owns, like cash, receivable, factories, equipments. Liabilities are what the company owes, loans, creditors, unpaid expenses. Shareholders' equity is simply the difference, the value that belongs to the owner of the company. When you look at the balance sheet, focus on debt levels. A company drowning in debt may face trouble in tough times. Cash reserves. A healthy cash position shows strength. Working capital. Current assets minus current liabilities. Active working capital can be a red flag. Example: Reliance Industries has very high debt when it was investing heavily in Jio. But in the past few years, by selling stakes to Facebook, Google and global investors, it has reduced debt significantly. That's a positive sign. So the balance sheet is like your personal net worth statement. It shows what you own, what you owe, and what's left for you. The income statement. Next is the income statement, often called the profit and loss account. This tells you how much money the company made during a specific period, usually a quarter or a year. It starts with revenue, the top line, then subtract various costs, cost of goods sold, employee expense, marketing, admin and other operating costs, leaving you with operating profit or EBITDA. From this subtract depreciation, interest and taxes, and finally you get the net profit, also called the bottom line. What should you look for? Is revenue growing year after year? Are operating margins stable or improving? Is the company constantly profitable? Example, Asian Paints. Even during tough times, when raw material prices rose or demand slows, Asian Paint manages to maintain margins. Why? Because it has a strong pricing power and brand quality. This consistency shows up beautifully in its income statement. Think of the income statement as your salary slip. It shows you earnings, your expense, and what's left over as saving. For companies, the saving is profit. Now comes the most underrated but most important one, the cash flow statement. Why is this so important? Because a company may show profit on paper, but what matters is cash in the bank. Cash flow tells you whether the company is actually generating money or just playing with accounting numbers. The cash flow statement is divided into three sections. Operating cash flow, cash generated from the core business. This is the most important part. Investing cash flow, money spent or received from investment, like buying a new factory, acquiring another company, or selling an assets. Financing cash flow, money raised from debt or equity and money paid out as dividend or buybacks. A healthy company should have positive operating cash flow, which means its core business is bringing in real cash. If profits are rising but operating cash flow is negative, that's a red flag. It could mean the company is recognizing sales that aren't actually collected yet, or it's tied up too much in receivables. Example, many infrastructure companies in India at times showed profit in their P&L, but when you check cash flows, money wasn't coming in because clients weren't paying on time. Eventually, many of these companies collapse. Here an easy analogy. Balance sheet is equal to a photograph of your wealth today. Income statement, your monthly salary slip. Cash flow, your actual bank account statement. The cash flow statement proves whether the salary slip actually matched the money credited. Putting it together. Now, why do we need all three? Because they complement each other. The balance sheet shows what you own and the income statement shows whether the business is profitable. The cash flow statement shows whether the profit is turning into real cash. Looking at just one is dangerous. Imagine analyzing only your salary slip without checking your bank account. On paper, you are rich. In reality, maybe you are broke. This is why, and as investor, we must always cross-check all three statements. So to summarize, let's learn to read a balance sheet for assets, liabilities and debt. Study the income statement for revenue growth and profitability. Always check the cash flow to confirm whether profits are real. Together, these three financial statements form the backbone of fundamental analysis. Without mastering them, it's impossible to evaluate a company properly. In the next section, we will move from raw numbers to something more actionable, ratios and metrics that make comparison between companies easier and faster. Now that we have covered the three financial statements, let's talk about the next step, financial ratios. Ratios are like shortcuts. Instead of reading hundreds of numbers in an annual report, ratio help us summarize and compare companies quickly. Think of them as the health indicator of a company. Just like blood pressure, sugar level or cholesterol help doctor assess a patient's health. We will break them into four categories: profitability ratios, valuation ratios, debt ratios, efficiency ratios. So let's dive in. Profitability ratio tell us how good a company is at turning revenue into actual profit. Earning per share EPS. This is the net profit divided by the number of shares. It tells you how much profit belongs to each share. Example, if Infosys earned 25,000 crore in profit and has 500 crore shares, EPS is 50 rupees. Higher EPS means the company is making more money per share. Return on equity ROE. ROE measures how efficiently the company uses shareholders' money. Formula is net profit divided by shareholders' equity. A 15% ROE is generally considered good. For example, HDFC Bank has historically maintained ROE around 17 to 80%, that's strong. Return on capital employed, ROCE. This is like ROE but include debt as well. It shows how well the company uses both equity and debt together. Very important for companies with high borrowing like steel or cement. Net profit margin. Net profit divided by revenue. It tells us how much of each rupee earned become profit. FMCG companies like Hindustan Unilever have net profit margin of 15 to 20%, while retailers like DMart may have lower margin but make up with high volumes. So profitability ratio answers. Is this business truly profitable and efficient at making money? Second is valuation ratios. Now even a good company can be a bad investment if the stock is overpriced. That's where valuation ratio comes in. Price to earning, PE ratio. This is the most important one. Formula: price per share divided by earning per share. If a stock trades at 1000 and EPS is 50, then PE is 20. Lower PE means cheaper valuation, but be careful. A high growth company can justify a high PE. Example: Infosys traded at around 25x earning, while some PSU bank may trade at 8x. That doesn't mean PSU banks are better, because growth prospects differ. Price to book, PB ratio. Price divided by book value per share. Useful for financial like banks because their assets and book value matter a lot. HDFC Bank might trade at 3 to 4 times book value, while weaker banks may trade at below 1x. EV to EBITDA, enterprise value divided by earnings. Before interest, tax, depreciation and amortization. This is very useful for capital intensive sectors like telecom, power or steel, where PE alone is misleading. PEG ratio, price by earnings divided by earnings growth rate. It adjusts the PE for growth. A peg of 1 is considered fair, less than 1 means undervalued relative to growth. So valuation ratio answers: am I paying too much for this stock or it is fairly priced? Third one is debt ratios. Debt can make or break a company. These ratios help us see if the company is drowning in loans. Debt to equity ratio. Total debt divided by shareholders' equity. A DE below 1 is usually safe. Above 2 may be risky, unless it's a capital heavy sectors like infrastructure. Interest coverage ratio. EBITDA divided by interest expense. This shows how easily the company can pay its interest. If the ratio is less than 2, it's a warning sign. Above 4 or 5 is comfortable. Example: Jet Airways once had a very low interest debt ratio before it collapsed. Debt burden was just too high. So debt ratio answers: is this company financially stable or is it at risk of being crushed by debt? Fourth one is efficiency ratio. Finally, efficiency ratio measures how well a company uses its resources. Inventory turnover. Cost of goods sold divided by average inventory. Higher turnaround means the company is selling product faster. For example, DMart has very high inventory turnover because its products fly off the shelf. Assets turnover. Revenue divided by total assets. This shows how effectively assets are used to generate revenue. Manufacturing companies often focus on this. Efficiency ratio answers: is the company making the best use of its own? The golden rule. Now here's something crucial. This shows how effectively assets are used to generate revenue. Manufacturing companies often focus on this. Efficiency ratio answers: is the company making the best use of what it owns? The golden rule. Now here's something crucial. Never look at a ratio in isolation. If I tell you a company has a PE of 40, is that good or bad? You can't say unless you compare it with its peers. For example, Asian Paints at 50p may still be attractive compared to Bazaar Paints because of strong brand margins and market share. Always compare with competitors in the same industry. Look at historical trend of the company's own ratios. Combine multiple ratios instead of focusing on just one. Closing this section, so let's recap. Profitability ratios tell us how effectively money is made. Valuation ratios tell us whether the stock price is justified. Debt ratio shows financial stability. Efficiency ratio measure how well resources are used. Together, these ratios act like vital signs of a company. And when you combine them with the financial statement we discussed earlier, you get a much clearer picture of the business. In the next section, we will move beyond numbers into something harder to measure. Qualitative factors like management quality, competitive advantage, and industry trends. This is where investing becomes an art as well as science. We have talked a lot about numbers, balance sheet, ratios, cash flow, but investing is not just about numbers. It's also about people, business, and industries. This is where qualitative factors come in. These are the softer, non-numerical aspects that can make or break a company, and often they are the reasons why two companies in the same industry with similar ratio perform very differently on the long run. Over the long run, let's look at the four most important qualitative factors. Management quality. Competitive advantage, also known as moat. Industry trends, government policies and regulations. Management quality. The first and the most factor is the management quality. Remember, when you invest in a company, you are not just buying share. You are trusting the people who run it. Two things matter here, integrity and competence. Integrity are the promoters honest and shareholder friendly? Do they treat minority shareholder fairly, or do they siphon off money? Example, Infosys built its reputation on transparency and ethics. That's why investor trust is so much. On the other hand, companies caught in scams like Satyam lost investors' trust overnight. Competence. Do the leaders have the vision and ability to grow the business? Example, HDFC Bank's leadership has consistently delivered growth for decades. Contrast this with companies where management keeps changing direction without clarity. How do you judge management quality? Read annual reports and look at the chairman or CEO's letter. Follow quarterly earnings call to hear how management answers thought questions. Look for consistency between what they promise and what they deliver. So management is the driver of the car. Even the best engine or balance sheet will fail if the driver is careless or dishonest. Competitive advantage or moat. The second qualitative factor is the competitive advantage, also known as moat. Warren Buffett says, "In business, I look for economic castles protected by unbreakable moats." A moat is what protects a company from competitors. Type of moats include brand power. Strong brands let companies charge higher prices. For example, Apple in technology or HDFC Bank in financial services. Cost advantage. Companies that can produce at a lower cost. DMart is a great example. It operates with razor thin margin but makes money through massive volumes. Network effects. More people use it, the more valuable it becomes. Think of Jio in telecom or Facebook in social media. Switching cost. When customers find it difficult or costly to switch providers, for example, Tally in accounting software or Bloomberg Terminal in finance. A strong moat means the company can defend its profit for a long time regardless of competition. Industry trend. The third factor is industry outlook. Even a great company will struggle if it's in a declining industry. Think about it. The best typewriter company will still went out of business when computers came in. So you need to ask, is the industry growing or shrinking? Is it cyclical or defensive? What are the tailwinds and headwinds? For example, EV adoption is a tailwind for battery manufacturer. Renewable energy is a long-term growth story. On the other hand, industries like traditional print media are in long-term decline. It's also important to differentiate between cyclical industries like steel, cement, or airlines, which move up and down with economic cycles, and defensive industries like FMCG, pharma, or utilities, which remain stable in any economy. Investing in cyclical requires good timing. Investing in defensive is more about steady compounding. Government policies and regulations. The fourth factor is the role of government and regulation. In some industries, regulation plays a massive role in profitability. For example, banking is tightly regulated by RBI. Rules on NPAs, provisioning, and capital adequacy directly affect profits. Telecom has seen huge swing because of government spectrum policies. Remember how Jio's entry disrupted the entire industry. Pharma is impacted by FDA approvals and government price controls. Policy changes can create opportunities or risk. For instance, India's push toward renewable energy is benefiting solar companies, while ban or restrictions can hurt tobacco or liquor companies. So always keep an eye on government announcements, budgets, and regulations. If you are analyzing a regular sector, pulling it together. Now let's connect these four factors with an example. Take Yes Bank and HDFC Bank. On paper, both are private banks. Both showed good growth numbers for a while. But the difference, management quality and integrity. HDFC Bank had consistent, trustworthy leadership. Yes Bank management took excessive risk and had problems. The result, one became India's most trusted bank, the other collapsed. Or consider Asian Paints. Its moat is its distribution network. Dealer, painters, and customers are deeply tied to its ecosystem. Competitors like Berger and Nerolac have struggled to break this moat. Even though the industry is open, this is why qualitative factors often explain why some companies become multi-bagger and others fail, even if their ratios one look good. So closing this section, so to summarize, management quality, honest and competent leadership is not negotiable. Moat, strong competitive advantage protect long-term profits. Industry trends, a good business in a good sector grow far more easily. Regulation, policies can create or destroy opportunities. Number tell you what the companies have done. Qualitative factor help you judge what the companies can do in the future. And remember, investing is not just science, it's also art. The art is in understanding business beyond numbers. In the next section, we will test everything we have learned so far with real case studies. Example of companies that got it right and that got it terribly wrong. Now that we have learned how to do fundamental analysis, let's see how it works in the real world. Case studies help us connect theory with reality. And today I will walk you through two contrasting stories, one of success and one of failure. Case study 1, HDFC Bank. The power of strong fundamentals. If you have invested in HDFC Bank in the late 1990s, you would have seen your money multiply many times. Why? Because this is a textbook example of a company with rock solid fundamentals. Look at this chart. HDFC Bank's profit CAGR over more than 20 years has been steady climbing. This consistency is no accident. It comes from strong fundamental disciplines, a conservative lending policy, and excellent management execution. When we read their annual report, we see the same story repeated year after year. Steady growth in deposits, prudent lending with low NPAs, focus on technology and customer service, and a strong capital adequacy ratio. Now let's connect this to the stock price. From the time of its listing in 1996 to today, HDFC Bank stock has turned into a multi-bagger, rewarding patient investors massively. The lessons here: when a company delivers consistent earning growth with good governance and a strong fundamental, the stock price eventually reflects that. This is what fundamental analysis help you identify business with the potential to compound wealth over decades. Now let's see the case study 2 of Yes Bank. Weak fundamental, painful outcomes. But not every story has a happy ending. Let's look at Yes Bank, which teaches us what happens when fundamentals are ignored. At its early year, Yes Bank grew rapidly, attracting many investors who believed it was the next HDFC Bank. But if you had dug deeper into numbers, you would have noticed warning signs. As their NPAs, non-performing assets, started rising, profit began to decline, their loan book was growing too aggressively, and risk management was weak. News report eventually confirmed suspicions. Cases of fraud, poor corporate governance, and loan given to risky borrowers. The result: the stock, which was once traded near 400, crashed all the way down to around Rs 20. The RBI had to intervene and investor lost huge amount of wealth. The lesson here is equally powerful. Never chase growth blindly. Always check the fundamentals, especially NPAs, governance quality, and whether growth is sustainable. Final takeaway from case studies: HDFC Bank and Yes Bank are two sides of the same coin. One shows how disciplined growth and strong fundamentals create long term wealth. The other shows ignoring fundamental and chasing hype can destroy wealth. This is why fundamental analysis is so critical for every investor. It's not about short-term stock movement, but about understanding the true health of a business. Now that we have seen how to apply fundamental analysis with real-world case studies, let's talk about something equally important: the mistakes most retail investors make. Understanding these traps is critical because avoiding mistake is often more important than chasing returns. So let's go through them one by one. Mistake number 1: only looking at P/E ratio. Many beginners think if a stock has a low P/E ratio, it must be cheap, and if it has a high P/E ratio, it must be expensive. But that's a dangerous oversimplification. For example, a company could have a lower P/E ratio when its profits are failing, debt is piling up, or the industry is in trouble. In that case, the stock is cheap for a reason. It's a value trap. On the other hand, some great companies trade it at a higher PE because the market expects strong growth for years to come. Think of companies like Asian Paints or HDFC Bank. They have always traded at a higher valuation, but they delivered consistent returns. Lesson: never rely on PE. Always look at the full picture: earning growth, debt, return ratios, and management quality. Mistake number 2: ignoring debt. Another huge mistake is ignoring the debt level of a company. Debt is like fire in controlled amount. It can be useful, but if it spreads, it can burn the entire house down. Many infrastructure and power companies looked very attractive on the paper with rising revenue, but when you check their balance sheet, the debt to equity ratio was sky high. When interest rates rose, or project stalled, they simply couldn't repay and the stock collapsed. As an investor, always check debt to equity ratio, ideally below 1 for most business. Interest coverage ratio, can be company pay interest comfortably, and whether the company is generating real cash flow, not just accounting profits. Lessons: profit can be manipulated, but debt levels are real and they can sink even the biggest companies. Mistake number 3: chasing hot tips. This is probably the most common trap. You heard a you you hear a friend, a WhatsApp group, or a TV analyst saying, "Buy this stock, it's going to double in 6 months," and you jump in without research. Visualize this as an investor running after a hot tip signboard only to fall into a pit. That's what happens in reality. Sometimes you get lucky, but more often you are the last one entering after the stock has already run up. When the price crashes, you are left holding the bag. The truth is, there are no shortcuts in investing. Tips can make you money once or twice, but they won't make you wealthy in long run. Only disciplined investing in fundamentally strong business can do that. So lesson learned: do your own homework, use tips as idea for research, not as ready-made buy signals. Step number 4: no diversification. Another common mistake is pulling all your money into just one or two stocks. Think about it. Even if you pick the best company, there are risks you cannot control. Regulatory changes, industry disruption, or management issues. For example, if you had only invested in Yes Bank, you would have lost most of your wealth. But if you have diversified across banking, IT, FMCG, and pharma, one bad apple wouldn't have destroyed your portfolio. A good rule of thumb: keep at least 12 to 15 stock in your portfolio, spread across different sectors, and keep a portion in index fund or mutual fund for stability. Lesson learned: diversification doesn't guarantee profit, but it protects you from disasters. So, to summarize, the biggest trap retail investor fell in: over relying on PE ratio, ignoring debt, blindly chasing tips, and not diversifying properly. If you can simply avoid these 4 mistakes, you are already ahead of 90% of retail investors. Remember, successful investing is less about making brilliant decisions and more about avoiding big blunders. Protect your capital first and the return will follow. Now that we have understood the mistakes to avoid, let's move to something very practical. Here is your 7-step checklist for analyzing any stock. Think of this as a roadmap. Whenever you are evaluating a company, just go through these steps one by one. Step 1: business model. First ask, how does this company actually make money? A lot of investors skip this, but it's the foundation. If you don't understand the business model, you cannot predict its future. For example, HDFC Bank makes money by lending, but its edge comes from low cost deposits. Asian Paints sell paints, but the real edge is its distribution network and reaches every corner of India. If you cannot explain the business in one or two sentences, it's too complex. Skip it. Remember Warren Buffett rule: never invest in a business you cannot understand. Step 2: financial statements. Never dive into the numbers. Income statement, balance sheet, and cash flow. Don't worry, you don't need to be an accountant. Just focus on the basics. Is revenue growing steadily? Are profit rising along with revenue? Is the company generating real cash or just showing paper profits? A company like Infosys saw consistent revenue and profit growth for decades. On the other hand, some companies show profit on paper but no cash flow, a red flag. Lesson: Numbers tell the story behind the business. Listen carefully. Step 3: Ratios. Once you understand the raw numbers, ratio give you quick insight. Some key ones to track. ROE, return on equity. Is the company creating value for shareholders? ROCE, return on capital employed. Is it using capital efficiently? Debt to equity ratio. Is the company over leveraged? Net profit margin. How much profit per rupee of sales? For example, FMCG companies like Hindustan Unilever have given ROCE and margin shows efficient operation. In contrast, capital heavy business like airlines often struggle with low margins. Ratios simply complex data into clear Ratios simplify complex data into clear signals, but always use them together, not in isolation. Step 4: Peer comparison. No company exists in isolation. The market is a competition. For instance, if you are analyzing ICICI Bank, compare it with HDFC Bank, Axis Bank, and Kotak. If one bank is growing despite faster, has better margins, or fewer NPAs, you know where the strength lies. Similarly, in IT companies, TCS versus Infosys versus Wipro, peer analysis help you spot the industry leader versus laggard. Lesson: A company may look good alone, but only comparison shows whether it's truly strong. Step 5: Management check. This is less about numbers and more about trust. The best business model can collapse if management is dishonest or incompetent. Things to check: track record. Have they delivered on promise in the past? Corporate governance, any history of fraud or regulatory issues? Skin in the game. Do promoter hold significant stake? A real contrast: HDFC Group has always had a reputation for clean governance and investor friendly practice. Meanwhile, companies like Satyam collapse purely because of management fraud. Bet on people you can trust because you are handing them your money. Step 6: Growth prospect. Now ask, what does the future look like? Past performance matter, but the future decides return. Look at industry trends. Is the sector growing? New product launches or expansions? Government policies or tailwinds? Example: renewable energy companies are expected to grow as India shifts toward clean energy. On the other hand, certain outdated sectors may stagnate even if they look cheap. A strong business in a declining industry may still underperform. Step 7: Valuation and entry point. Finally, when the best companies can be a bad investment if you pay too high a price. Valuation tool: PE ratio versus industry average, price to book value, discounted cash flow for advanced investors. For example, Infosys in 1999 was a great company but trading at a sky high valuation. Investor who bought at the peak waited years to recover. In contrast, buying good companies during correction has historically given the best returns. Always combine quality with the right price. So here's the full 7-step checklist. Again, understand the business model, study the financial statement, check key ratios, do a peer comparison, evaluate management quality, assess growth prospect, and decide on valuation and entry point. If you practice this process step by step for every stock you analyze, you will filter out the noise, avoid emotional decision, and build a portfolio of fundamentally strong companies. Remember, investing is not about finding shortcuts. It's about having a structured process and sticking to it. Alright friends, let's wrap this up. Remember one golden principle from Warren Buffett: Price is what you pay, value is what you get. Stock market investing isn't about chasing the hottest stock or the loudest news headlines. It's about carefully identifying good business and then waiting for the right opportunity to buy them at a fair or discounted price. If you focus on strong fundamentals, quality management, consistent earnings, growth, and sensible valuation, you are not just buying a stock, you are buying into a business that can grow your wealth steadily over time. And here's the secret: wealth in the stock market is built with patience. Don't expect overnight miracle. Instead, aim for steady compounding because small gains year after year become extraordinary wealth over a decade. So the next time you look at a stock, don't ask, will it go up tomorrow? Ask, does this business deserve any ownership for the next 10 years? That mindset will transform your investing journey. So these are the popular websites listed for fundamental analysis of stocks. Yahoo Finance, TradeView, Morningstar for the global businesses. And for India specific, we have Skinner.in, Money Control, Ticker by Phenology, and NSE India. If you enjoyed this video and learned something new, don't forget to hit an like button. It really helps the channel. Make sure to subscribe and tap the bell icon so you never miss our future videos on investing and personal finance. And I would love to hear from you. Drop a comment below and tell me which investing principle from today's video will you start applying first. Thank you and Jai Hind.